I want you to pause for a second before we even look at a chart, because what's happening in the market right now is not random. It's not noise, and it's not just volatility. This is exactly how market rollovers begin. And if you've been following my recent videos, you already know this moment was coming. I told you the most important level on SPY was 681, not 680, not somewhere around there, but specifically 681. That level was holding the entire structure together, and once it gave way, the market was no longer bullish, it was vulnerable. And now, that vulnerability has officially turned into weakness. We've lost 681 decisively. Not a wick. Not a fake breakdown. We lost it, failed to reclaim it, and now price is sliding rapidly towards 670. As I'm recording this, we're vacillating around 672. And I'll be very direct with you. There is almost no scenario in my mind where we down T touch 670. Whether that happens intraday, post-market, or pre-market tomorrow, it feels inevitable. We're seeing expansion candles to the downside. Momentum is accelerating, and there's very little meaningful bounce along the way. That tells you sellers are in control, not buyers stepping in aggressively. Now here is the key part, and this is where most traders get emotional and lose objectivity. Hitting 670 does not automatically mean the market is crashing. It means we are arriving at the decision point. This is the level that determines whether the rest of the year gets ugly, or whether we actually get one final gift before the calendar flips. Earlier this week, I said that if the market was going to reveal its hidden bearishness, it would show itself this week. And today was that confirmation. The failure to reclaim 681 wasn't just technical, it was psychological. Bulls tried. They failed. And once that happened, the path of least resistance became lower. So now all eyes are on 670. There are two scenarios here, and there is no third option. Either we hit 670 and cut straight through it like a knife through butter, or we hit 670 and see serious, undeniable buying interest. I'm talking about strong volume nodes at the bottom of the chart, aggressive dip buyers stepping in, and price actually respecting that level instead of just tagging it and continuing lower. If we slice through 670 without a fight, you need to understand what that implies. That doesn't mean a one-day crash. It doesn't mean panic tomorrow morning. But it does tell us that the broader market structure is breaking down, and the next real area where we'd expect support is closer to 650. That move wouldn't happen overnight. Markets rarely move in straight lines, but it would mean that rallies become selling opportunities, not buying opportunities. And honestly, from a long-term perspective, I wouldn't hate that outcome, because I still believe the AI-driven rally is very much alive. I still believe 2026 is going to be a massive year for many of our favorite names. A deeper pullback now would simply reset sentiment, shake out weak hands, and set the stage for the next major leg higher. But, and this is a big, but if we hit 670 and we bounce, if we see volume confirm that buyers are defending that level, then the entire tone of the market changes. In that scenario, we could absolutely drift higher into the final days of December on low volume and get what people love to call the Santa Claus rally, which historically is just the last handful of trading days in December and the first couple in January. That type of melt-up would make perfect sense. Low liquidity, short covering, institutions window dressing their books, and price slowly grinding higher while everyone argues about whether it's real or fake. That is why tomorrow's price action, especially pre-market and early intraday, is so important. How we hit 670 matters just as much as whether we hit it. Now let's zoom out for a moment, because context matters. Even in a worst-case scenario, where SPY drops all the way towards 651, which is the October pivot low, we wouldn't technically be crashing. We would simply be rotating within the same range we've already been trading in. The October high around 688 and the October low around 651 defined the broader consolidation zone. So a move lower doesn't automatically mean the bull market is dead. It means the market is digesting gains. That's why I keep saying this isn't about fear. It's about levels. And the level right now is 670. If we can hold 670 into Friday's close, there's a very real chance that we drift higher into Christmas week. If we lose it decisively, you already know what comes next. Now, while the broader market sorts itself out, there are individual stocks that are setting up beautifully. And this is where disciplined traders separate themselves from emotional ones. Let's talk about Netflix for a minute. I know some of you are still in this trade, and I want to make something very clear. I love Netflix going into 2026. This is not an overnight trade. This is not a momentum chase. This is a structured, patient setup with a clear plan. Netflix has been under pressure for a while, largely because the market had to price in the debt and uncertainty surrounding the Warner Brothers and HBO acquisition. That kind of deal always creates short-term pain. But fundamentally, nothing is broken. The business is strong. The brand is strong. And once the dust settles, I believe we see this stock working its way back toward all-time highs around 134 over time. What's important right now is what the chart is telling us. Netflix hit the 78.6 Fibonacci retracement and respected it. Since then, price has reclaimed that level and begun consolidating above it. On the daily chart, the story gets even more interesting. We're seeing a series of higher highs and higher lows. That's not random. That's accumulation. No, this hasn't been a rocket ship. We've moved from the low 90s into the high 90s, and price is clearly facing resistance between 94 and 97. But consolidation at resistance is not bearish. It's constructive. The target at 102 is still valid. The key is risk management. If you're in Netflix, you need a stop-loss plan. The low of the most recent green daily candle is 93.32. Any stop beneath that protects you from a deeper pullback while still allowing the trade room to breathe. This is how you stay in winning trades without letting them turn into losers. Now let's talk about Micron Technology, because tonight's earnings are a big deal. Micron is one of the most interesting AI-related stocks in the entire market right now. It's the fifth strongest stock in the S&P 500 this year, up roughly 176%, and only recently began to cool off. That pullback has scared a lot of people, but context matters. This stock isn't breaking down. It's cooling off after an incredible run. And here is the part that should get your attention. Micron is trading at roughly 11 times forward earnings. Most AI names are sitting between 25 and 30. That's a massive valuation gap. So while price has pulled back about 17% from the highs, that move looks far more like profit-taking than the start of a long-term downtrend. On the chart, Micron is sitting in what we call the golden zone, an area where reversals frequently happen. I've got an ascending channel drawn, along with Fibonacci levels, and the trigger to the upside is very clear. 228.57. A move back above that level puts the stock back into the middle of the ascending channel and opens the door to a move toward 237 and potentially back toward 240. If earnings disappoint and we lose structure, then yes, 208 becomes the next downside magnet. That's the risk. And that is why we don't gamble into earnings. We wait for price to tell us what to do. What makes this setup especially interesting is the options flow. We've seen a $38 million call sweep into the $200 strikes expiring next week. That's not retail. That's smart money positioning on a pullback, right before earnings. Does that guarantee a move higher? No, but it tells you someone with deep pockets is betting on strength. So here's the takeaway. For Micron, for SPY, for the entire market, price is truth, not opinions, not headlines, not hope. We wait for the levels to break or hold, and then we act. That's exactly how we traded this morning. As the market rolled over, we took puts right out of the open using my A-plus scalp alerts. We caught the flush, locked in 30 to 40% on multiple trades, and then even grabbed a small call scalp for 8% before rolling back into puts again. 4 trades, controlled risk, clean execution. This is what disciplined trading looks like. And as we move into the end of this year, I want to make you aware of what's coming. The Stocks with Josh Discord is undergoing major expansion. Starting in 2026, we're adding 3 more live trading sessions to Power Hour, bringing the total to 12 weekly live sessions where you can trade alongside me or one of my crown traders. We're also rolling out my full A-plus scalp indicator suite between now and year end. If you're already a member in the traders tier, you're getting that as a Christmas gift. If you join in 2026, it becomes an additional premium cost. So if you've been on the fence, this is the window to get grandfathered in before the upgrades go live. If you want to learn how to read charts, how to trade levels instead of emotions, and how to navigate markets like this with confidence, go to the name of the show, StocksWithJosh.com. We're heading into a critical moment in the market. 670 is the battlefield. How price reacts there will shape the rest of this year and set the tone for 2026. So hit that like button, subscribe to the channel, and stay tuned, because I'll be covering Nike and FedEx earnings next, and those are going to be very telling for consumer strength and economic momentum. As always, have a plan, stay patient, stay disciplined, because that's how wealth is built. Peace and blessings.